Crypto really isn't that complicated. There are only two price drivers that move things up and down. The first price driver is the long-term trend, as in how much money is flowing in and out of the system. Are people moving their money from traditional finance into crypto, or are they moving it from crypto to traditional finance? We can see that with the stablecoin minting and redemption process. We'll look at this in a second. The second driver is what's the swapping activity within crypto. Are people now currently mainly in stablecoins, or are they currently mainly in risk-on assets, so Bitcoin and altcoins, etc.? So we can actually segregate those two effects. And when we do this, we get a very nice prediction of how quickly Bitcoin will grow over the next months, potentially years. Now let's start with effect number one. Money flowing in and out of crypto from traditional finance. That is this line over here. So this is the stablecoin market cap. Sometimes money is flowing into crypto. So that's when people deposit their fiat currency on a centralized exchange. The centralized exchange sends this over to a custodian. So for example, Circle or Tether. And Tether then creates the tokens on the chain. And we can see that creation in this chart. When people redeem their money, so let's say here after the Terra Luna crash, when people got very scared and they wanted to get their money out of crypto, that's then when you go to Binance and you say, withdraw my funds, give this back into my bank account, and then the custodian has to return the funds and has to burn the stable coins that you have sent to them. So this is then when this is going down. So this chart going up means money is flowing in. This chart going down means money is flowing out. And currently we tend to see deposits into crypto. So the market is expanding since October of 2023. So that's our first sign that over the medium term, we are likely going to see increased crypto prices. When there's more and more capital available to speculate with, then of course prices should, as per tendency, go up. But we all know that it's not as straightforward, right? The stablecoin creation chart is way less volatile than crypto prices. Bitcoin goes up and down all the time, but we've just seen how there was very little volatility in the stablecoin market cap chart. Now all of that volatility in the crypto prices comes from swapping activity. So that's when people move from risk on to risk off and from risk off to risk on. And a nice indicator to measure how much people are currently risk on versus risk off is the stablecoin dominance. So now we look at the market cap of all of the stablecoins and we put this into relation of the market cap of all other cryptos. So how much of all of crypto is now risk off or in the stablecoin? And that's then what we get with this chart over here. At the top, the stablecoin dominance is at 19%. At the bottom, it's at 5%. And in the last 1.5 years, we tended to trade in a range between 5% and 9%. And there is a direct inverse correlation with crypto prices. So what we see here at the bottom, that's the Bitcoin price. So when the stablecoins get deployed, when stablecoin dominance is going down, then Bitcoin goes up, and vice versa. When Bitcoin goes down, that means people have swapped back into stablecoins. In other words, if we believe now that stablecoin dominance is going to go down back to 5%, then the Bitcoin price should go up. We've talked about this in prior videos. If we make that analysis, if the same amount of stablecoins get deployed again, then Bitcoin should hit roughly $130,000, $140,000. But for this video, I want to make a slightly different analysis. I want to look at how much can we expect Bitcoin to grow long term. Let's say we don't see another Terra Luna collapse. We don't see another implosion of FTX. We continue to see the stablecoin market cap expand as we have seen since October of 2023. If the current trend continues with that expansion, how quickly is Bitcoin expected to rise? So we are ignoring the ups and downs of the market. We are just working with the stablecoin expansion. So here's what we can do. We can compare two data points. We can compare this bottom over here. So that's when the market was very much risk on, when a lot of the stablecoins had been deployed and there was not that much more dry powder. And then we've got a very similar point over here. So we're now looking at the 12th of March 2024 to the 5th of December 2024. The degree to which stablecoins were deployed at both days was very similar. And so all of the price appreciation that we saw between those two data points must have been 100% just money flowing into the system. It was not the system getting more risk on, because the risk aversion was exactly the same. It's all just the market itself expanding because of money flowing from traditional finance into the crypto world. And so let's ignore timing the market. Let's just look at how quickly Bitcoin could grow if money continues to flow in as quickly as it did during those two data points. Now, is this a realistic assumption? I believe it probably is. Even if you look at the logarithmic scale and we connect those two data points, our current growth rate, as in money flowing into the system, has been sustained since the 24th of December. And so let's just compare this. How much did the stablecoin market cap grow during that time? The answer is roughly 32%. How much did Bitcoin grow during that time? The answer is 35%. So very similar. There might be a slight leverage effect because not all of Bitcoin is liquid, right? There is some Bitcoin that gets lost over time, but in general, it seems like the expansion of the stablecoin market cap mirrors the Bitcoin price appreciation. And so between those two data points, we've got 266 days and an appreciation of 35%. So 35% divided by 266 days, that's a gain of 0.13% per day. Or if we take the entire year, it's 48% per year. Now, this is not 100% accurate because instead of compounding, we just divided and multiplied. So it might be a bit higher than that, but still, it's roughly 50% per annum that we should expect Bitcoin to go up if we don't see a Terra Luna-like crash, if we don't see an FTX implosion. So if something systemically doesn't suddenly implode out of nowhere, if we don't get a black swan event, then Bitcoin is expected to appreciate by 50% per annum. All we have to look out for is that the stablecoin market cap continues to grow at its current rate. Now, this is of course the bull scenario, and at one point something will implode. But I do believe that we can time the market to a degree, right? We are looking at all of these data points in order to outperform the market, in order to be better than the average market participant. My guesstimate is actually that across the cycles, so if we include the Terra Luna collapses, etc., that Bitcoin's growth rate is roughly 25% per annum. Now, of course, it used to be way larger than this, but the 25% per annum come from the increase of the average cost basis of the market. So the market is going up and down with massive volatility. In order to remove that volatility, we can just look at what's the average cost basis increasing over time, or the reference price. So that's the orange line over here. That's the realized price. And of course, the realized price tended to go up a lot in the past. Now it tends to grow slower because Bitcoin's market cap is way larger than it used to be. And of course, if we want to time the market, we better buy when the average market participant is in losses, right? When the current price is below the realized price. This is, I believe, actually how Bitcoin gets mainly priced. Because nobody knows what's the fair value of a Bitcoin, right? Is it 1 million? Is it 10 million? Is it just $50,000? Nobody has a real estimate of what a good price for Bitcoin should be because we don't have anything to base it on. When we have a stock, we know that the value of a company is its future cash flows. When we've got a house, the same is true, right? The future income that we get from the house, when we discount it with the present value, then we get the current price of the house. That's at least what academia tells us. For Bitcoin, we don't have anything like this. The only thing we have is the reference price, as in when people are in losses but believe in Bitcoin long term, they will just wait it out because the tokenomics of Bitcoin are better, as in there's less expanding Bitcoin compared to fiat. Fiat currency expands by roughly 6.8% per annum. That's how quickly US M2, or the US money supply, is expanding. The Bitcoin supply doesn't expand as quickly. So in other words, we can just wait it out if Bitcoin drops. And this is what tends to happen. So when the reference price is currently higher, or the average market participant is in losses, the selling pressure tends to subside. When currently people are in gains, some people might consider taking those gains and then use this for consumption or use this to allocate to other asset classes. So we definitely want to buy Bitcoin when the market is below the realized price. But that's beside the point, right? The main thing is the realized price increases by roughly 25% per annum since 2018. And so that's what I believe is a realistic return expectation. We can boost that return by timing the market. Again, we've got that data for a reason. We can also boost the return by only being majorly invested as money is flowing into the space. But without all of that market timing, I believe it's 25% per annum across the cycles, and it's 50% per annum while the market is expanding, while money is flowing into the system. And so we can time the macro, and we can also time the micro just by looking at the stablecoin dominance. When there's no more dry powder on the side, when the stablecoin dominance is at 5%, it might make sense to exit, at least partially, right? Nobody has a crystal ball, but when it takes additional inflows from the fiat world to push the price higher, but the volatility of Bitcoin is high, the risk to reward might not be as great compared when there's a lot of dry powder on the side. And we can rise very quickly just in a matter of a few weeks. Here's something I haven't shared that often on this channel. I actually studied investment management. I studied financial analysis. That was in Hong Kong. That was for a Master of Science. But a lot of the things that I learned at the time, I had to unlearn afterwards. There are a lot of misconceptions that are present in academia that don't apply to the real world. For example, the idea of efficient markets, that the current price that we see for any asset is already the balanced demand and supply of the asset. All of the information that's publicly available is already baked into the price. This is definitely not correct, and I've got proof for that. For example, check out the following. This is the YouTube channel of Jesse Eckel, another crypto YouTuber. And he just published a video on how he recently put $10,000 into this dead altcoin. The altcoin was the winner token. The video had been published on the 6th of May. Now here's the difference between most markets and the crypto market. The nice thing about the crypto market is that we can figure out what other people are doing. All the information is public, but that public information isn't used by a lot of people. Most people don't go at length to find out who's buying what, who's selling what. And if we do some on-chain analytics, we can find the wallets of various people. For example, over here, we've got a signal that Jesse Eckel bought the winner token, not for $10,000, but for $10,005. That was on CowSwap, and that was on May 2nd, so 4 days before publishing the video. This is actually what we see very often within the crypto space. Unfortunately, because of the very little regulation in the space, pump and dumps are super common. People buy the token first and afterwards publish a video on the token, hoping for this to garner some attention, hoping for this to push up the price, which to a degree works. It works better in a bull market than in a bear market, but especially for small cap cryptocurrencies, it still works to a degree. And so check this out. This is when Jesse Eckel bought. So he bought for 0.64 cents on the 2nd of May, and the subsequent 2 days, not much has happened. Then for whatever reason, on the 5th of May, the trading volume went up a lot. And my suspicion is, I don't have proof, I'm not part of his premium group, but my suspicion is that he talked about the token to his insiders just 1 day before publishing the video. That was then when the inner circle got in. And then subsequently on the 6th of May, when he published the video, the price went up further. So since he bought, the price went up by 22%. And so obviously all the public information, as in Jesse Eckel buying into the token, was not baked into the price at 0.64 cents, because most people were not aware of that public information, because most people don't go at length to figure out who owns what wallet. And so we are not the only ones that follow this strategy. There is an entire YouTube channel just dedicated to tracking wallets, and that's across the Rubicon. And in an ironic inception kind of way, we are tracking across the Rubicon as well. And they bought, for example, the Trump token, and that was at $3.36. So here is their YouTube channel. They've got 141,000 subscribers. And here is Trump. They basically bought the token in the first 4 hours after launch. They got the massive gains. It's all about being early. The price went up by more than 1,500%. And the vast majority, right, the people that aren't following crypto that closely, they lost. And so when people tell me that crypto is just random gambling, here is proof that it is not just random gambling. Yes, there is a luck component involved, obviously, but there's also a skill edge. And that's why money concentrates towards a few winners over time. Most people lose, but the people that put in most effort, they win. And it's not just about wallet tracking, it's not just about being early, it's about understanding supply and demand in general in crypto. Most people, for example, overlook tokenomics. They don't really understand the supply side, but price development is supply versus demand. For example, this here. This is the Balancer token. So this is a very old decentralized finance protocol. And sometimes it goes up, sometimes it goes down. But when it goes up, it tends to be because all of crypto is going up. It tends to be just Bitcoin appreciating and thus helping the altcoin market as well. When we look at Balancer relative to Bitcoin, the price development is way more clear, right? Balancer tends to underperform Bitcoin, and we can again make money from this. So that's also not common knowledge. We don't have to make money by betting on rising prices. We can make money by betting on falling prices, and it doesn't have to be the falling US dollar price. It can be the falling relative valuation. So if one token underperforms Bitcoin long term, as did Balancer, we can make money from that underperformance. We can make money from the relative valuation, not just from the US dollar price changes. So still, up to this day, we can make profit as this chart continues to go down. And this is much easier to bet on than trying to figure out what next meme coin might pop. Now, why is Balancer going down consistently like this? Again, it's tokenomics. It's simply the supply expanding very quickly over time. And if demand doesn't grow as quickly as supply, and the supply is broadly dispersed into many holders' hands, we tend to see continued selling pressure. Of course, the price in US dollars can come up when Bitcoin goes up, but we are not betting on that. We are betting on the relative valuation. And so this is what I strongly believe in. I think the more we learn about a market, the more skill edge we have. And in the end, since we have both skill and luck involved in crypto trading, if we have enough skill and if our sample size is high enough, we tend to get more and more gains. So we maximize our expected value. Or in online poker terms, one would say our EV. I used to play online poker actually professionally. This is how I paid for my studies in Hong Kong to begin with. So I was half of the year in Gibraltar, the other half I was in Hong Kong, and I was studying in Hong Kong for that financial analysis degree. But yeah, I've published more than 100 tutorial videos, for example, on how to make money by shorting altcoins, how to do the proper risk management without getting liquidated, how to make money by relative valuation shorts. So that's that video. It's 42 minutes in length. Then there's another entire tutorial section just on how to find various influencer wallets. So this is how we know why Jesse Eckel bought before publishing the video. We are tracking various influencer wallets, more than 500 in total now. And there's an entire course just on how to find influencer wallets. For example, through the NFTs that they are holding, for example, through the centralized exchange deposit addresses they use, for example, through related transaction wallets. There's many different approaches. And we then discuss those approaches and we share our findings in the wallet research chat. So yeah, for example, here is a post of how CryptoGains talked about the Champ token, and we knew before that. Just another example. And so here's our influencer trade channel. So here we see when people pump and dump tokens. So Kyle Chessy, for example, is currently de-risking. He's selling a lot of his meme coins. So feel free to check it out. It's currently $125 US per month. The link is down below. It's thebitcoinstrader.com. There should also be a link directly on this video here on the right. So feel free to just click on that. It will lead you directly to the sign up page. If you got some value out of this video, feel free to give this a like. It helps the channel grow. Feel free to also subscribe. I publish videos regularly. See you next time on YouTube or see you in Premium. Cheers.